the one room, particularly now where there's trade tensions between our two countries. APEC was always a very good way of keeping the dialogue going bilaterally, as well as the regional meeting.
So as you said, APEC represents 60% of the economy. What are they going to do to help each other out of the crisis that we're in now?
Well, I think most of the focus at the moment will be on keeping markets open in terms of trade and investment. Of course, very hard to travel in terms of tourism and education, but rocks and crops, mining and agriculture have been moving across the region very effectively. And I think most of the focus will be on vaccine cooperation. We had some real problems last year, even within Europe, where France were denying Italy the vaccines and Germany was holding them up, and the AstraZeneca vaccines were being held up to Australia from Europe. So I think that they want to have vaccine cooperation within APEC as much as they've been able to have trade and investment cooperation traditionally, because it's really been a consensus organisation about trade and investment issues. But occasionally when you get a major global event like COVID-19, they try and use it as a mechanism to get more international cooperation.
Is China part of APEC?
It is, and so is Chinese Taipei, as they call Taiwan, basically because APEC is about economies, not countries. So Taiwan and Hong Kong are also members along with China.
So while this is all being held with the spirit of cooperation, of course, which we all want to see, do you foresee any tensions at all?
I think there always is, particularly at the moment. I think when APEC was first envisaged, Australia had pretty clear lines that we cooperated with our major defence partner, America, traditionally through the alliance, through ANZUS and so on. But then we saw the rise of China as our number one customer now in terms of exports and imports. So it's been reasonably difficult. I was just on a call this morning with the Australian Embassy in Washington and Harvard University, and it is quite different now in the sense that we have the rise of China as a strategic partner. It's also a very important customer for Australia, so we have to balance our defence and strategic interests with our economic interests, and that's where using agencies, organisations like APEC, I guess gives us another forum to manage these types of tensions.
Well, let's hope there's more agreement and less tension. Thank you so much for the update. The airport economist flies again, Tim Harcourt. Have a great weekend.
Thanks, Annette.
And switching gears to our chart of the day. This is from the friend of our show, Nick Bishop from Bishop Fang. Core CPI compared with bond yields. And of course, you have to point out how far away are we from that R squared, April, May and June. That's telling us that core CPI in recent months has accelerated from 3 to 4.5%, nowhere near where it used to be. Let's run that R squared again, that's all I can say. And if you love charts, of course, please join Kara on the trade at 2:45 every day after Startup Daily. In economic news earlier this morning, New Zealand inflation is scorching hot, 1.3% quarter on quarter. Analysts looking for 0.8. All sectors except communication contributing to that quarterly increase. Overnight, jobless claims easing, but this time bang on expectations, dialing down from 389,000 to 360,000. June industrial production rising by 0.4, which is a slight miss, as analysts were looking for a rise of 0.6. However, as we keep saying, supply constraints means that a slump in car production was behind the miss. The July Philly Fed Manufacturing Index crashed from 31 to 22, far weaker than 28 expected. In contrast, the July Empire State Manufacturing Index surging from 17 to 43. That's an all-time high on its vaccine rollout. Markets were only looking for an unchanged print. in round 2 of his testimony, this time to the Senate Fed Chair Jerome Powell, saying that price rises were still not broad-based across the economy. In contrast, one of the FOMC members, Evans, sees QE tapering by year-end as the recovery unfolds. Across the pond, we've seen a switch from noted Dove, BOE MPC, Monetary Policy Committee member Mike Saunders changed his tune, saying that the question of whether to curtail our current asset purchase program early will be under consideration at forthcoming meetings. Let's turn to China, and we've had a lot of data in the last couple of weeks, particularly yesterday, with second quarter GDP just shy of expectations. However, on a quarterly basis, the numbers were a little better than expected. So for his take on those numbers and the outlook, Kevin Xi joins us from CBA. Good morning, Kevin. Thank you for joining us. Now, of course, we get a lot of data all at once when it comes to GDP. We get the month of June as well as the quarter. What sort of momentum did you see in that quarter that's worth highlighting?
Good morning. I think if you look at the June dump data, that's actually quite resilient. Is from an annual growth rate perspective, they definitely have beat expectations. But I think at the moment, because of the base effects caused by the pandemic, it makes more sense to focus on month-to-month growth rates. So if we look at the monthly growth rates of the 3 key economic activity indicators, so first of all, the overall economic momentum sort of continued. But the production side remains stronger than the demand side. So the IP in the industrial production growth actually picked up slightly, but the retail sales and also fixed asset investment monthly growth rates has actually ticked down slowly. So, but I think looking forward, so the fiscal tapering, which announced earlier this year, will continue to weigh on parts of the economy, especially the infrastructure investment, but also the property investment, because the government have, continued the de-risking drive to curb speculation and leverage in the property sector. So from that perspective, we expect property investment continue to decelerate for the rest of this year. And the infrastructure investment might, stabilize or could ease slightly because, the governments have also increased scrutinize the risk-taking behavior in the local governments. So, but on the other hand, we expect the manufacturing investment continue to pick up because of a recovering global economy and also recovering domestic demand. So overall, we expect for the rest of the year, momentum continue to stabilize. The other factor is the PBOC. So, the PBOC last Friday has delivered a 50 bp cut to the RRR, which is required reserve ratio. So that will help the economy for the rest of the year as well.
So in terms of one thing I noticed with the data is that consumption is now over 60% of GDP. Now that puts it in line with most Western countries. So do you think that means China's getting closer and closer to first world status?
I guess if according to our projection, if China can continue grow for the rest of this decade, it's very likely China could become a high-income country and escape middle-income trap by end of this decade. And of course, because lots of structural issues, economic growth in China will slow gradually. So we project that by end of this decade, which is 2030, economic growth in China will decelerate from about 5.86% to only 4%.
So just in your earlier answer, you were talking about those RRR cuts. Are you expecting another cut between now and year end?
Yeah, we do expect another cut. I think there's quite a few things going on here. First, we think really because of the sharp deceleration in credit growth, sort of caused the policymakers to step in and cut the triple R. So, we know credit growth normally leads economic growth in China. So the sharp deceleration in credit growth could cause issue later this year and become restrictive to the economic growth. So from that perspective, the policymakers, deliver this preemptive cut to triple R to offset some downward economic pressure down in the second half of this year. But also, I think there's a structural consideration as well in the medium term. As you have said, China is trying to escape this middle income trap, and so China needs to find a new growth engines. So in the past couple of decades, China relied on construction, property investment, infrastructure investment. So these infrastructure investment. So these commodity heavy and construction focused investment have propped up the Chinese economic growth. But going forward, China wants to have other growth engines such as high tech, green development, small medium sized company, but also high value added industries. So in that way, the PBOC have to sort of shift limited credit resources to prioritize the areas. So that means the PBOC have to, on one side, have continued de-risking drive in these targeted areas. But on the other hand, the PBOC have to offer a helping hand to priority areas. So in the way, when the PBOC cut triple R, and so channel credit to these targeted areas to find a new growth engine.
So, and of course, here in Australia, we keep a close eye on China. So we'll be talking to you again. Thank you so much, Kevin, CBA China analyst. Have a great weekend. And that does it for the big picture. As always, time flies, but stick around because it's Friday and it's Jun Bei Liu from Tribeca and Adam Dawes from Shaw and Partners joining Nadine today. They're going to wrap up the week with their life-changing stocks, so stick around.
Hi everyone, I'm here to find out a little bit more about sustainable investing, and to help me understand what it's all about, Katie Constance joins me now from Fidelity. Katie, welcome to you. Now, exactly what is sustainable investing?
So sustainable investing, which can also be referred to as ethical, responsible or ESG investing, is a long-term investment strategy which seeks to integrate environmental, social and governance considerations into its process. Environmental issues can include climate change, deforestation and pollution. Social issues can include modern slavery and child labour. And governance issues can include executive remuneration and gender diversity. What sustainable investing seeks to do is invest in companies with strong, sustainable characteristics.
Is sustainable investing increasing in popularity?
So over the last decade, sustainable investing has become increasingly important, and there are now over $1 trillion of assets invested in a sustainable manner in Australia. There are a variety of reasons why investors choose to invest sustainably, and that can be to align their investments with their underlying values and beliefs, to diversify their portfolio, or to reduce risk. At Fidelity, our view is that by investing in companies with strong standards of sustainability, we can protect and enhance returns for our clients and contribute to a more sustainable financial system for society as a whole.
Some great insights there. Thank you, Katie.
Thanks, David.
Look out for more of our sustainable investing insights with Fidelity, or visit their website.
5-star investing starts with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
Good afternoon to you. It is Friday, the 16th of July. Great to be here with you from a lockdown Sydney for The Call. This program is it, isn't it? 10 stocks picked by you, 2 experts, and all done over the space of 1 hour. And today, I feel sort of lucky to be here. Koshi's out of the office today, and I get to wrap up his life-changing stock series. And I've got 2 fantastic guests. Jun Bei Liu is joining us from Tribeca Investment Partners and Adam Dawes from Shaw and Partners. It's great to have you both with us. Also great to have you with us if you are watching us on YouTube, Facebook, or Twitter today. So guys, we've got a great audience for our life-changing stock series. So let's get right into it. No pressure. I'll start with you, Jun Bei Liu. Now, this one is a company that we have discussed. I think even you and I have discussed it on The Call before. Aroa Biosurgery. The ticker code is ARX. I'm not going to steal any of your thunder, but why could this, over a long-term investment horizon, potentially, be life-changing in monetary terms?
Look, it's life-changing in 2 ways. One is that you can make substantial amount of financial return out of investment in this very early stage, very fast-growing business. And then secondly, that this is a company where it will change people's life, literally. So let me get into it. So Aroa is a very fast-growing early stage business, a wound care product. It is now already using over 4 million procedures around the world to date. Its product is essentially used in the hernia repairs markets, in trauma accidents, in chronic wounds, and as well as many other areas. Now, its product has been tested, and there's lots of clinical data supporting how effective it is in healing the wounds. And then the company itself is now selling. The product is selling around the world, in the US, across Australia, Europe. Lots of agreement in place, and it's doing very, very well. It is trading at a fraction of the valuation of what the larger peers like PolyNovo is. And also, notwithstanding its addressable market is far larger than what PolyNovo is within. So to us, it's a company that will, significantly increase in value. And also, it is something that does help people to heal. And as it grows its suite of products, it certainly is a life-changing company.
Yeah, so don't look at that chart. That's wrong. Aroa Biosurgery, so that is Jun Bei Liu's life-changing company. Now, Adam, Jun Bei, we'll ask you though, because this is, as you mentioned, it's just early stage. It's too small for your fund right now, is it?
With Aroa, it's not.
Okay.
So we are essentially following where the money is. So we have this company in our portfolio. And this company, literally, it's done very well. Only listed last year. It doubled on day one. And, we think there's a lot more opportunity going forward, even if although I say it's early stage as in the addressable market is enormous. Compare this company with PolyNovo, in terms of the data and clinical support and the amount of procedure that's being performed here, it's not that early stage. So it's proven product that's been selling very well.
Great, got it. Okay, now let's go to Adam Dawes. Calix is yours, CXL. I had the pleasure of speaking with the managing director, Phil Hodgson, just last week. So, Adam, if you're there, walk us through. Yeah, we're just getting you up on screen. There you go. It's nice to see your face. Talk us through your life-changing, potentially life-changing company.
Yeah, look, this one's a great little one for a lot of investors because I think it ticks a couple of the boxes. First of all, that box of ESG. Now, we've talked ad nauseum about ESG and what that actually looks like, but certainly ESG is one of those ones where that, and I always call it the wall of money that is flowing and coming down the line. And the Calix sort of fits really nicely into that bucket as far as ESG. So that's the first thing. The second thing is that it is quite small market cap. It is a little bit illiquid, but it means that retail investors can get set. Now, the stock has definitely moved, sort of over $1, sort of last year, and now $3. But I still think there's a monumental upside to that. So we still remain really, really positive. Now, obviously, Calix is one of those ones that takes, and there's a couple of, it's basically takes CO2 emissions out of, pretty much anything that it can do, but really it's concentrating on the cement industry and then taking out the CO2 emissions plus the heat that is used to create concrete or create cement. It's quite an environmentally damaging business as such to do that. So what I'm really liking is that it gives this business and gives the ability for people to have a little bit of a feel-good story around it. We remain positive. Obviously, industry tailwinds are the most certain to remain supportive to the company, as well as a series of potential catalysts based on revenue plus gross profit margin, and assuming that they can then move that just from cement to wastewater, agriculture, crop protection, all of these kinds of things going forward as well. So this one's a little small one. I think that's got lots of revenue and it's got some really good royalties coming through. I think this one is a life-changing one for somebody's portfolio.
Wonderful. All right, CXLARX. Thank you, guys. Thank you for those picks. And if anybody out there watching would like to hear what the CEOs of both of those companies have to say, you can just go to our website. We've got a number of interviews with them up there. Let's get into the companies that have been nominated by our viewers. The first one has been brought to us, our attention at least, by Claudia. Now, the first company is Liberty Financial. Adam, I was reading a Citi note the other day that said share market investors can profit from the strength that we've seen in the property market, but not via the big banks. They should be looking at Australian Finance Group, AFG, and also Liberty Financial. Would you agree?
Yeah, look, it's certainly a way to play that because obviously it's a mortgage funding business. So, one of those things is that we really like this side of the business. And, it's all about the net interest margin. So in other words, what they can actually put to the market and what that margin that they can have. So I really think that this one does look okay. It's probably a hold from me. I'm a more of the view that I'll probably prefer to be in the banks as such because there is a little bit more diversification. So that's something that I think you could definitely look at. But look, the target price for most brokers is around about that sort of $9 mark. So look, there is certainly some upside there. And I think if they can keep that earnings profile looking good, I think if they can do that, and there's a comparable valuation of Pepper Money as well, PPM, that has come through. So I think the forecast should stay the same. For me, this one is probably a nice little hold at the moment, just because I probably prefer the big banks.
Jun Bei, would you prefer to be in the big banks as opposed to some of these other ways that you can leverage the hot property market?
I hate to agree with Adam on the first call. I'm going to be yes.
There's nothing wrong with agreeing with me.
Look, no, absolutely right. Sorry, I lost visual for a second. I absolutely agree with you. I think bank is a much better place to be. Now, for this company, it's probably a hold for me. It's really because the current operating environment is it's as good as it gets, right? So, for the earnings, it's about volume and margin. Now, for the volume, yes, we got mortgages, we got things that's going well. But for margin fronts, interest rates are very low. So this company has benefited from falling interest rate because they borrow, they get it from the bank and from other places from very low rates, and then they lend it out at a reasonable rate. So they make a margin. Now, the rates where they get all the funding has been so low because the banks giving it them at a very low rate. But if anything, in the next 2 years, you have to agree that the interest rate is on its way up. We're already seeing the fixed rate for mortgages are already going higher. So, in that sort of environment, this business is going to do okay for the next couple of years. But looking ahead, that margin will be under more pressure. And especially now the banks, pulling everything together. It's not very expensive, paying big dividends. So I'd much rather to be in the banks. This one's a hold for me as well.
Got it. Okay, that's Liberty Financial Group. We are out of the blocks with agreement all around. Let's see if that holds true for the next company on the list. MLD, it's Maca. It's for Malia. I think that's how you pronounce that as well. It's in the contracting space. It's diversified. It works in Australia and internationally as well. I'm wondering, though, about labor costs eating into margins. I mean, we saw that in Rio's quarterly update that came through today. Jun Bei, let's start with you.
Oh, okay. Sorry. Start talking already. Look, I think you're absolutely right. The main issue at the moment for this sort of mining services space is that, yes, there's a lot of demand for there. There's an opportunity to do a lot of work, but there's no labor, especially, the exposure, the ones with exposure to the Western Australia market, which this one does. And then the thing is, we can't see the border opening up anytime soon, perhaps 6 to 12 months. So, they will be continued under pressure. This company, though, it is very, very cheap and it's very well managed. So, we actually think that, a lot of those businesses actually represent quite a bit of value heading into results, because think about the pressure on labor. It's already known. And last 6 months ago at the interim result, we heard from all the mining services. So, there's a level of expectations of, tough condition for these guys. And it is so cheap that, I think it warrants a look. But at this point, it still holds. But I think this result might give a bit more clarity on how they see things going. But it is a very well-run business.
Okay, so Adam, that's a good point. If it's well run, you do want to buy these mining services companies when they are, cheap. So is it a buy based on valuation?
Yeah, I'm going to echo Jun Bei's commentary on the last stock, which is LFG, and just talking about how it's probably as good as it gets with this sector as well. We're in the mining sector. We've seen very high commodity prices. We're certainly seeing fantastic dividends. But we all know that mining companies are cyclical and commodity prices are cyclical. So you really need to look at that and basically understand that this cycle is potentially at the top end, or we could probably go for another sort of 6 months, but this is at the top end. I would have thought Maca would have been doing a lot better now, and you can see that January side, it was definitely sitting up there at $1.50, and then, it's certainly come back. I think it's probably as good as it gets for the mining services side of things. These guys do some really good stuff in the mining, crushing, civil construction, infrastructure, and mineral processing. So it is quite diversified. But yeah, I'd say it's a hold because I think it's the wrong time to be investing in with the cycle where we are at the moment.
Got it. So that is a avoid at this time for you. All right, next on the list, Woodside Petroleum. We just learned yesterday not only that sales surged 67% in the June quarter, but also that it is looking to sell down its stake in the Pluto LNG asset. It doesn't want to be the sole owner before it makes that investment decision there. So, Jun Bei, Woodside Petroleum, do you buy it now on the expectation of rising sales and prices, or is this a risky option as the whole world moves to renewables?
Look, there's a really big question. I think for the short term, so next 12 months, I think the energy space looks very, very strong. And energy equity like the Woodside and Oil Search and others certainly has lagged the rally in the oil prices. And with the world return to travel, at some point we'll be out of our doors and then be lining up for traveling overseas. That will provide significant amount of demand for for jet fuels and then demand for oil. At the same time, I think the OPEC pact now have a very clear, view of, increasing supply behind the demand. So that means the oil price will be reasonably supported. So with those insights, the energy space looks very good. Over the long term, yes, Obviously we have renewables and others. But in between, there's a lot of money can be made just simply because Western world is not investing those assets, and then so it will make them more and more scarce. And at the same time, a huge global recovery in activity around the world is going to create that tension. So there's good money to be made. Now, Woodside itself, I don't like it. I much prefer to have exposure to the Santos or Oil Search. Just give you a lot more leverage to that front. Much prefer purer play rather than businesses does have some of its structural issues. So I'd much rather to play the other names, and they certainly will be in the portfolio.
Yeah, okay, so that is a bit of a bonus coming from Jun Bei, Santos and Oil Search. So yeah, the Pluto LNG expansion project, if they get this other partner, will potentially get the go-ahead for construction later this year. So how do you view Woodside, Adam? Is this a short-term play potentially or long-term?
Look, it's a long-term play for me, and Woodside definitely moves on the oil price. And so they came out the other day for their quarterly and said that they're sort of getting average of $75 a barrel for their oil and LNG. So that's actually fantastic, and hence their revenue on the upside was a beat. However, production was a little bit lower. But I think the second quarter result wasn't really structural for Woodside, and that, look, trading costs have certainly, or higher costs, caused them to sort of have a little bit of a pullback on those numbers. Look, I've been struggling with this whole energy space because of what's happening in the ESG space or in this green space, and it's really, really difficult. If you take a step back, 85% of the world's energy needs is still fossil fuels. So that only leaves about 15% that's in this green space. So albeit there's lots of talk about ESG and there's lots of talk about all this stuff, but basically we still need oil to turn on a light. We still need oil to grow and drive the economy moving forward. So I don't think you throw Woodside out now. I think it's a buy. I really like this business. It's fantastic. It pays good dividend. It is the largest in our sector, so I'm very comfortable to recommend it to clients. We have a buy on it, Shaw and Partners. I'm always a little bit concerned, and sort of to Jun Bei's point, I'm actually a little bit concerned about something like an Oil Search. They're in Papua New Guinea. I don't really know the government's stance there, and we have seen in Oil Search and Papua New Guinea government changing a couple of times, which does affect that investment thesis. So I think you've got to make sure you understand the geopolitical stance before you invest in some of these companies. So that's why I really like Woodside, because it's here in Australia. They certainly are going to do well. They need to find a CEO to get those to work that out. They do need to get those asset sell downs before they make their final investment decision. So there is a little bit of work that Woodside needs to do to get some confidence back in there. But I think where it's sitting, I think it's $22-23 where it is today. I think, look, that's a fantastic buy, and I'm really comfortable to put it into clients' portfolios.
We have a disagreement happening here. So there you go. A buy from Adam Dawes, not so from Jun Bei for Woodside Petroleum. Okay, Spark Infrastructure has come to us. I don't actually have the name of the viewer that one's come from. Clearly, there's a lot of newspaper inches being written about Spark Infrastructure right now. We've been talking about it a lot because it has had a takeover approach. Now, it's rejected that approach. It's denied the group due diligence. It's a consortium that includes the Ontario Teachers Pension Plan. I was speaking with David Lane from Ord Minnett this morning, guys. He said, Jun Bei, don't expect an improved offer coming through for Spark Infrastructure. Just going by memory, I think you like this company as a safe sort of option. Is that correct? Has your view changed at all?
No, not this one.
Okay.
It's the other Spark. So look, this one they're okay, but the business is not really growing. Earnings going backwards. All it is it offers a good dividend yield. But normally, as the investors, equity market investors, you invest in something, give you dividend yield, also give you a bit of an inflation hedge, so your earnings grow a little bit. But this one actually, doesn't tick the box for many. I think what this is happening with this Spark is that, it's just a sign that the money's so cheap around the world. Super funds, pension funds are struggling to find unlisted infrastructure or long duration assets. So what they're doing is that trying to bring a lot of those listed assets that is not sort of being recognized for its valuation, taking them private. So just a week before, we heard from Sydney Airport, that was the bid as well. So, so I think we will see a lot more of it. So with this company, if I hold it, look, you probably can hold out for a few percent. Your downside is probably limited, but your upside is probably limited too. So the next logical thing is that, similar sort of stock, what else can get bid? APA is another one that get talked about quite a bit. Another company that's sort of infrastructure business sort of being challenged a little bit, but it's on 6% dividend yield. So, and then so there's a bit of, investors looking to potentially someone else can look at those assets. But look, invest for M&A can take a very long time. We thought Sydney Airport would get taken out. That was a year ago, and it took a 12 months for people to, put the deal together. So it's risky to invest for M&A, but certainly you can look at some of the companies. Does give you good dividend yield, does have a strong infrastructure-like sort of assets and position in them.
Okay, Adam Dawes, Spark Infrastructure, not Spark Telecom. Do you like it?
Yeah.
If you're already a shareholder, there wouldn't be a reason to sell now.
No, don't sell if you're already a shareholder. Absolutely, do not sell. I think look, whether there's another bid that comes across. I mean, certainly the Ontario Teachers Pension Plan and KKR, which is the sort of the private equity side of things. These guys have got very, very, very deep pockets, and they're looking for assets, as Jun Bei said, all around the world. I think really investors should definitely look, taking a step back, I think investors should definitely look at infrastructure to put into their portfolio, because these pension plans, these funds are going to be asset hungry, exactly as Jun Bei said. So you've seen Sydney Airports, you've seen Spark, and APA took a little bit of a bid, not takeover bid, but as in buying, going into it as well. The other one you can have a look at is AusNet, AEST. That's also in that space. But let's get back to Spark. I think Spark is a fantastic business. I do have it in clients' portfolios. At this level, I would be cautious and I would hold. I wouldn't be buying any more here. But the reason why these pension funds and these guys really like this business is that they can project out 10 to 20 years worth of earnings. It is that sort of stable that they like that kind of thing going forward. So that's what we really like about this space, is that projected earnings and the ability for these things to move forward. So for me, I think it is definitely a hold. Be cautious here. If obviously that bid doesn't come through, the stock's going to come back, but then I'll be comfortable to buy it because of that forward-looking earnings.
Okay, so if it does have a pullback, this would actually become a buy for you.
Yeah, correct. Yeah.
Okay,
absolutely.
Good. So it's a hold for now from both of our expert guests here. That's Spark Infrastructure, SKI. The next one on the list is for Michelle. And this is Adore Beauty. So this is a fast-growing company. It's in that online e-commerce space. It is for, everything sort of personal care. And I was reading in some of the Fairfax papers that its CEO wants to go for growth. And she's looking at you, Adam. She thinks, obviously, with about half the population being men, that's the next frontier for Adore Beauty. Will you be hopping online? I'm not insinuating anything, of course, but would you be hopping online to buy Adore?
This is a hard one. Jun Bei got this one right. She took it up on the IPO and then got out of it pretty quickly. I took it up on the IPO and I'm still holding it for clients. So I'm not doing so well in this one. Look, I think Adore Beauty has a fantastic business because it is online. And I think with COVID and obviously with these snap lockdowns going as we are at the moment, people will continue to buy online. And I think people's people's buying habits have changed to make sure that this thing, to make sure that they continue to buy online. But my problem is that Adore has continued to tell the market that they are looking for growth. They're looking for private labels, and really they had a fantastic prospectus, but they really haven't been able to meet that prospectus forecast. So I think for me, it's a hold. I'm really struggling because I've got clients still in at IPO prices and I've got to wait until we got to sort of get back to that level. So I'm just a bit cautious because it came with post-pandemic numbers and they were fantastic. Now, people, do they still go out? I don't know. Do they still go to Myer and buy their lipstick, or do they, do that kind of stuff, or do they continue to buy online? it's a tough one for me. So I'm going to say hold. I got it wrong, and we're waiting to try and dig ourselves out of a bit of a hole on this one.
Mea culpa. But again, I will get emails at the end of this program from people saying, why not sell now? Why would you wait for a potential another downgrade or for another bad announcement to come through? Because it's not just about holding on to recoup your losses sometimes. It's about, cutting and running.
Yeah, or even buying more at this level. I mean, if I think it's going to get back to $6, $7, potentially where the IPO was or the IPO price,
exactly.
I should be buying more at this level. So look, I agree. Sometimes clients don't like taking a loss, so that's a little bit difficult to broach that subject. I think, I think it's a great business, and I really did like it. I can't see any translation to the end profit numbers, but like some of their EPS numbers are fantastic, and their site numbers and their analytics that they've got is fantastic as well. It's just the market potentially is not paying enough attention to it or enough multiple to it at the moment. So yeah, it's a hold.
Yeah. All right, Adam. Look, it's not a perfect science, is it, Jun Bei? Would you hold on? Would you buy now? Do you expect that the company's growth potential is such that it makes it good value now?
I would say all of these e-commerce business represents, it's time to start looking at them. But the key issue faced by all of those businesses like Kogan, like Temple & Webster, like Redbubble is that next 12 months, the earning looks quite tough because they're cycling 100% or 200% sort of growth. Now, the problem with that is that, when the sales number becomes a bit tougher, the competition picks up. So when competition picks up, as a retail e-commerce platform, they will have to spend. So most of them, to be quite frank, have no idea how much they're going to spend to hold on to that type of, their own market share. So next 12 months is a little bit unknown, for those businesses because their margin can halve in the next 12 months if the competition heats up. While everyone fights for market share, a shrinking market share. So that is the biggest challenge at this point. My view is that, I'm happy to take 12-month view. I want to use this opportunity to find the best price to buy the one that with this, the real moat about it. So say with Temple & Webster, I think it's doing really well in that, online furniture space. That's very interesting. Pay attention to what they do. Maybe in 6 months is the best buying opportunity. Maybe you can start easing your way in. Adore, for example, I think it's got a great platform, but I think like Adam says, it's because it's it's a newly listed business. You do want to see a bit more of achievement of what they said. It's not so much in guidance because the earnings guidance because market dynamic change. It's more about they talk about the strategy, the long-term strategy. Are they on track with it? Are they keeping up with doing some of the M&A and other things? Because if they do, maybe they can cement their market share. Then they can grow from there when we move past the next 12 months. So this is a good opportunity to look at those names. But look, the earnings will be very volatile just because even the retailer themselves don't know how much marketing they have to reinvest to keep that eyeball going.
Okay, so this is not a buy at current levels for you. Would you hold on to it if you, potentially were already invested because, if you're taking that view, you want to see the proof in the pudding in terms of strategy?
Yeah, I will probably look, to be honest, I think Adore has held up pretty well relative to the other e-commerce guys. So I would probably actually just sell it and then, wait for the better entry point.
Okay. All right. Thank you. Let's get to a bit of a sum up, shall we? We're halfway through the program already on this Friday afternoon. Again, great to have you along for the ride if you're watching us on Facebook, on Twitter, on YouTube, and of course, on our streaming platform. Let's get to the stock that could potentially change your life. Adam Dawes picked Calix. CXL is the ticker code there. He's got ESG and the massive amount of money that is flowing in to investment opportunities in that space. He says that it's got monumental upside and the potential for plenty of revenue to come through. Jun Bei's pick is Aurora Biosurgery. ARX is the ticker code there. She says it's life-changing, not only for potential investment returns going forward, but it literally can change lives. She just sees that it's got an enormous addressable market out there. So that is Jun Bei's life-changing pick. All right, let's get to some of the companies that were nominated by you. Liberty Financial, LFG. Both of my expert guests today, Adam Dawes from Shaw Partners and Jun Bei Liu from Tribeca Investment Partners, say they'd rather be in the big banks. It's all about net interest margins, and Adam just prefers the big banks for their diversification. Again, Jun Bei points to margins, which will come under pressure. She says it's about as good as it gets in terms of where we are in the cycle. So again, she'd rather be in the big banks. As good as it gets is what Adam thinks about the next company on our list, Maca. He says it should be doing better in this environment. It's an avoid for him. It's a hold for Jun Bei. She's watching the labor pressures that are coming through and how that will eat into costs or drive costs higher. But she does say that it's very cheap and it's well managed, so she's keeping an eye on it. It's a hold for her. Woodside Petroleum, it is a hold for Jun Bei. She says that, look, in the energy space, it's looking very strong over the next 12 months. She doesn't really like Woodside. She would prefer Santos or Oil Search. They are better leveraged to the price of energy and that will rise. So I think I'll call that a sell from Jun Bei. It is a buy, though, for Adam Dawes. It's a long-term buy for him whilst he does invest with ESG in mind. He says the reality is we still need oil to turn our lights on. So this company he actually likes over, say, Santos and Oil Search. He does see it as being leveraged to the price of oil. Spark Infrastructure, absolute hold from Adam Dawes. If it falls lower, if this takeover offer doesn't come to fruition, it would be a buy because it's got projected earnings. It's a safe and steady way to invest in infrastructure. It's a hold for Jun Bei. She says, look, its downside is limited, but its upside is limited as well. And then we get to Adore Beauty. This got Adam Dawes a little bit hot under the collar. I don't think he'd mind me saying. Look, it's a hold for him. He is hanging on for a lift in the share price, which is achievable. It just hasn't proved itself yet for him. Jun Bei, though, says that it's a sell. You can wait to get into a better entry price if you do believe that it will be able to execute on strategy. She says the space is pretty competitive. All of these e-commerce giant players are going to have to spend to maintain their market share. Adore Beauty is no exception. She's already made her money on that one. Anyways, let's get to our portfolio, the ausbiz portfolio. We've been tracking it since July 1st last year. This is thanks to our partner, NabTrade. All the companies that get 2 thumbs up or a buy from both of our experts in the show go into the portfolio. We have not got one in yet today. Let's check in on how it's going so far this week, up by 1.5% over the month, more than 1%. Full year to date, 37.5%. Recently, we've added Strike Resources, we've added Venturex Resources, Galaxy Resources, there's a theme, Flight Center, and MicroX. We've removed Premium, McMahon, and Bega Cheese. You can check in on that portfolio. Go to our website, ausbiz.co/portfolio. And I guess speaking of NabTrade, we check in with Gemma Dale weekly at 1 p.m. She tells us what's been moving on the NabTrade platform, and that gives us a really good idea of where the retail market is headed, or where it is coming out of. All right, guys, you're back. Welcome back. Let's get into the other half of this program. Regis Resources, RRL is the ticker code. This one is for Elliot. The gold price, I've got to say, looking pretty schmick lately. Jun Bei, how do you view Regis Resources in that space?
Look, I think it looks all right, but I have a much preference for much larger peers, the likes of Northern Star, where it merged with its, almost comparable a few months ago. I think, much rather to be in the larger names. In terms of the gold price, though, because the share price tend to move with the gold prices wherever it's going. Look, in the current environment, gold price will be volatile, simply because we are in a world where we've got a little bit of inflation. There will be a bit of growth returning, but the inflation is not too bad. So kind of in that sort of period, normally gold prices sort of, can become volatile, can stagnate a little bit. Gold price tend to do really well when, everyone's worried about the growth or, when inflation is through the roof. So somewhere in between is where we are at the moment. So I think the gold prices kind of look reasonable, and it's in terms of the upside to the share price, you really need the gold price to start moving.
Yeah, Adam, Regis looks pretty cheap as compared to a lot of the other ASX gold miners. It's low cost, it's pretty diversified, and it's got a pretty strong operating history. So why, we had the chart up there, why is the share price not coming along to the party with Regis?
Yeah, that's a really good call, Nadine, and certainly you're right. As far as a low-cost producer, they can produce an ounce of gold all-in costs at around about $1,300, and the Aussie gold price sitting around about $2,400 at the moment. It looks pretty good. But what's happened is that the one of their mines, or in fact, Regis Resources has downgraded their gold production going forward. One of their mines, which is the Duketon South mine, had an underground mine closure, and basically an open pit grades seem to sort of fall with that. Now they've basically said to the market that they were going to produce around about 300 to 350,000 ounces per year, but now they're getting to around about 200,000 ounces a year for the full year, but going up until 2026, and hence why the market is now selling down this stock on the back of that sort of production downgrade going forward. So, look, I really like management here. Management is very, very sound. They operate and they've got a really, really good track record. Regis is a little bit different as far as gold miners, because they're basically, it's not a porphyry, but basically they do high tonnage, low grade. So it is quite difficult, and they need to watch their costs every time they're pulling another ounce out of the gold. But at an all-sustaining $1,300 an ounce to get it out of the ground is still pretty damn good. If in anyone's language, I think Newcrest is just shy of $1,000. So it is something that. So to answer to your question, I think it's a hold for me. I don't think you need to be out of it, but I think you need to be very cautious about more further downgrades on this one. I prefer the big boys in the room, which is Northern Star and Newcrest. Both of those are doing very, very well. And as Jun Bei said, that with Northern Star merging with Saracen, it really then puts them up into that top tier of a gold producer. So I'd stay in that space, or even just invest in the gold, GOLD, the ETF, the commodity. Get rid of all the company risk and just buy the commodity if you think the commodity is going to go higher. We do think that the gold price should continue to rise. There's a bit of a gap there at the moment, so you can play that either way. But for me, Regis, only because the management there is at a hold from me. Okay,
all right. So Northern Star, I think, is a bonus buy, and GOLD is the ETF that you can leverage the commodity price off of. Next on the list, Plenty Group this week. We spoke with the CEO, actually. It's had a pretty good run. The quarter looked really strong. It's increasing its originations, but again, does this sort of go back to the Liberty Financial conversation that we had earlier on, that there's a bit of safety in the big banks? Jun Bei?
Absolutely. So this one is like the sexy version of the Liberty. So it's growing incredibly well. It's off a small base, and said there's lots of growth. I think latest quarterly is up more than 90%. So it's going really well. And there's quite a lot of player in that space. So current operating environment is pretty good for that whole the whole wholesale lending space. The one we actually follow for quite some time and quite like is Wiser. It's also in that space, and as I said, the operating environment is pretty good. So for the larger end, I much prefer to sit in the banks just because they're cheaper, they got dividend and defensive, all that. But then on the sexy end, you need to have some in the portfolio. I much rather to have a Wiser.
All right, Wiser would be the preferred pick in that space. Adam, Plenty, do you know it? Do you like it?
Yeah, sure do, and it's a buy from me. We've got a buy here on Plenty at Shaw and Partners. We've just upgraded our price target from $1.75 to $1.90 on that price target. As you said, that quarterly was absolutely fantastic as far as their originations of $216 million, up 26% on our numbers, and up 260% year on year. So those originations were fantastic, and obviously we're going to see that accelerate on an annualized run rate, and that could lift them up to around about $1 billion. So look, the loan book is growing 100% year on year. Annualized figures seem to imply that there's going to be significant profit, more than sort of $40 million for that book. And if they get that book over $1 billion and potentially get that higher, then there's more profit to be available there. They're in a nice space at the moment. They're doing a lot of sort of car loans or auto warehouse capacity, so they've got a bit of headroom there as well. And I think it's sort of catalyst rich as far as that. If we see another quarter moving like this, then the share price could continue to move higher. So it's a buy from me with a decent price target. So, yes, Jun Bei's right. You compare it to a Wiser, but I think this one, it has a less shares on issue. So that sort of gives me a little bit more. A lot of institutions haven't really looked at it because it is quite hard to get set in that. So I like it because then the retail investors can potentially get in there before the instos get in there. So it's just a little bit illiquid, so it's just been held back. Did have a bit of a bumpy ride on the IPO to start with, and has basically tracked sideways for the last sort of 6 or so months. But now starting to kick up, and that price action the other day just gave me a little bit more confidence. So it's a buy from me. Okay.
A buy from Adam Dawes for Plenty Group. PLT is the ticker code there. I'll start with you on this next one, Adam, because you were talking ESG. Australian Ethical, AEF, is the next one on the list. Look, just this week, it's claiming 50% growth in funds under management over the past 12 months alone. So that's $1 billion of new investment, 56% increase in net flows. I feel like I'm doing their promoing for them. But I mean, it certainly seems like it is benefiting from that push to ESG. So if you're interested in investing in an ethically enhanced way, is this the way to do it?
Well, yes, it is one way to do it. Absolutely. You can actually look at this, that the AEF advised that one of its emerging companies fund actually is going to pay a performance fee of $2.9 million because it outperformed the benchmark and the S&P Small ASX Industries over the last sort of 12 months. And that performance fee is around about sort of 20%. So look, some more money coming into the fund on the back of that guidance. And I don't think anybody minds paying for our performance fees when you outperform. So look, I think, yes, you're right. It does sit well in there. This one's obviously, it used to be a fund, and now they've obviously listed it. And then back in the day, this one was very, very thinly traded as well, and I think they've done a recap of sort of every 1 for 4 shares to get some more liquidity in the share price. I think it's done really well. What do I say? I think you're okay. I think you can buy this one. It is probably a great way to get that ESG ethical side of things. I do like the ETF, which is FAIR, which is the Australian one, and ETHI, which is the international ethical investment side of things. They're 2 ETFs from Beta Shares. I sort of prefer those. They're a little bit more diversified. But I think AEF is doing a really, really good job. So, look, I'm comfortable to buy this one in clients' portfolios.
Okay, it's a buy. I always hate asking active managers about other funds, but there you go, Jun Bei.
Nice,
would you be
nice?
I am very fair.
So what do you think about Australian Ethical?
Look, I think it's well run. It's got performance fees, so it's done well. And but the biggess question is, what do you pay for it? I know they got the right exposure with all that ethical front, it's you pay 100 times earnings for this company. This is probably the most expensive fund manager listed around the world, 100 times earnings, 18 times sales. So, I know they're in the right space. It's just way too expensive, this compared to the likes of Pinnacle, which is doing very well as well. It's on just over 20 times. the previous star Magellan that's on, similar sort of multiple, for 100 times, you're paying a lot. So if you want the growth of, sort of ethical, more ESG biased things, perhaps you should just focus on the ETFs and the like. Look, it's just very expensive to have exposure to it.
Yeah, I know you're fair, Jun Bei. We love having you on. And I think that this next company, Adam, you love. Global Data Center Investment Fund, GDC. Am I correct? I mean, I've been wrong a couple times today, but
no,
fill us in.
I really like it. Yeah,
okay,
absolutely.
why?
Why? It's fantastic business. So, where does all the data go? Anyone? Where does all the data go? It doesn't go to the cloud. It's not in the cloud. It actually gets stored in a warehouse that's temperature controlled, secure, and usually that's basically a big fridge, big warehouse that sort of sits in there. So the data center side of things, we've got a buy on this one as well. I think this is something that you can definitely keep your eye on. It is thinly traded around $1.77 today. Next DC is certainly the one in the big space, and look, that is actually starting to move a little bit today as well. So I think, look, the Global Data Center, or GDC, the stock code, is one of those ones that it is a growing data center business. It's a global one, as it says in the name. They've got some properties in France. They've got some properties in South America. They've got some stuff here and Guam as well, which is a really interesting space for them to be because a lot of the internet transacts or goes through Guam. So, look, I really like this one. It's a smaller one than the Next DC. Next DC struggles due to the fact that they've got to pay very large rents here in New South Wales and around Australia for their properties, whereas Next or GDC has basically come out and said that we're not going to compete in that metro space. We're going to go and move and go globally. So look, I think this is a really good one. It's one of those ones that you put in the back of your portfolio. You basically buy it and leave it. It did pay a little bit of a dividend the first year. It paid a little bit of dividend this year, but they are looking for growth. It's a really good business. I like it. So it's a buy from me.
It is a buy. I'm going to ask the question, which I think will help, maybe steal a bit of Jun Bei's thunder, but are these the big, massive data centers, or are these some of the smaller, more localized ones?
Yeah, so these are the smaller, localized ones. It's not like your Googles or your Yahoo, but it's still in that medium enterprise business space. So, it's still quite large businesses, still need data storage areas. So it does fit into that nice space. It's for the smaller companies, but also the medium sizes. But yes, it's not the Google ones or the large ones. Mm-hmm. And they can see that they can get better uplift from taking some of those smaller ones and then getting more growth, getting more. Because once a company's inside in their racks, inside the storage area, they don't really move. And then they can start uplifting rent. They can start uplifting the earnings of the business on the back of those people being there. So yeah, it's not the large ones, but it's those medium to small price enterprise businesses that they're targeting.
What do you think of it, Jun Bei?
I remember this one now. I think I like it. I remember we were talking about this, Adam, previously, maybe a few months ago. And Adam was going to get me the sell down detail, and I don't know what happens. And look, it's illiquid, so for large investors, institutional investors, very hard to buy. But which is in a way it's good for the share price because as the company does well, there will be more new investors coming on board, creating buying tension. So it's great for the share price. Look, it's got a great dynamic. I think the management had a good track record as well, so that's very important to follow. And then this whole data center is a great space to be. Next DC is pretty large, so so for them to keep growing and everything, so it certainly comes with a lot of costs and money, capital required to do that. Whereas this business is still quite small at early stage, so it will be a buy for me. This will be very difficult to get to into my portfolio just because the liquidity. I'm still waiting for Adam to come back with some sort of transaction.
Adam, I'm surprised you haven't sent Jun Bei that email.
Yeah, well, offline, Jun Bei, we can have a chat.
Okay. All right. So that one, guys, that's our first company going into the portfolio today. GDC is the ticker code. Thanks, guys. We've got one more on the list. I haven't left a whole lot of time for this one purposely. I know Raj has emailed in about this one. He's talking about the gold price. It's Aurelia Metals, AMI. We've sort of talked about the gold price already. We know that Adam and Jun Bei both favor the bigger players, Northern Star and the like. But again, Raj is saying, if you just look at value with this company, I mean, is the price right?
You want me to start on this one?
Sure, Adam.
Nadine?
Yep. So I keep forgetting we're not in the same room. Go ahead.
Yeah, absolutely. So look, AMI is actually a really interesting business, and it's had a bit of a checkered past. I think Glencore was in there for a small position in that. Now I think that they've moved on this one. Look, AMI again, I think is going to struggle because it's really all about that cost of getting that gold out of the ground. They've moved past that exploration stage, and that's potentially why I think this one has continued to struggle, is because those investors that are in for that exploration stage, there you go, you can see from 2017 up to 2018-19, that was the exploration stage, and now they're in production or trying to move towards production. So it does change the investor base a little bit, and that's why we're seeing this share price moving sideways or languishing a little bit here. I'll reiterate, I prefer the big boys in this room. If you hold it, I wouldn't sell it because I think it looks okay and gold price should move higher, so you might get a little bit of an uplift here. But for me, I'd rather be in the big boys.
And is that your view, Jun Bei, or is there anything else that you can add there for AMI?
Yeah, not much to add. It's the same. The big boys is better. Like, look, there's a lot of risk of getting the gold out of ground. So initially it was earlier, when you're exploring, looking for those gold, great share price rally with those news flow. But by the time you go to produce, a lot of things can go wrong. So you much prefer to be in the lower risk, the large boys, where give you good exposure to the high gold prices as well.
Okay, so that is not a buy from either one of our guests, Raj. Thanks for sending the email in. Actually, thanks to everybody who sent emails in for the companies that we did cover today. I'll just summarize quickly the second half of the show before I say goodbye to our guests. And we've got Adore Beauty. Sorry, that was in the previous one. Regis Resources, so that is a hold from both of my expert guests. Jun Bei says it looks all right, but bigger is always better. And Adam, he just heard him reiterate again, bigger is better. And you could see some further downgrades for Regis, but he does like the management in this company. Plenty is the next on the list. Jun Bei said it's a sexy version of Liberty, which we discussed earlier in the program, but it's not a buy for her. She would prefer to look at Wiser, for example. It is a buy at Shaw Partners. So Adam really likes this one. He says that this is a good one for retail investors because there's not a lot of institutional interest in it just yet. And he sees significant upside coming from here. So that is a buy for Plenty Group. Australian Ethical, it's expensive for Jun Bei. It's well run, charges a performance fee, but the question always is, what do you pay for companies? And it's just too expensive for her. It's a buy, though. For Adam Dawes, he says, look, no one minds paying for outperformance, though he does point to a couple of the ETFs in that ethical space, FAIR and ETHY, ETHY are the codes for that. A Global Data Center Investment Fund, GDC. Adam and Jun Bei are going to have a catch-up offline about this one, but it is a buy from both of my guests. It's going into the portfolio. It's difficult to get into. It's fairly illiquid, but it looks like it is going to do quite well in the future. So we'll see how that performs in the fund. Thanks, guys, for that. And the final company on the list was Aurelia Metals, AMI, just a hold from both of our guests. Jun Bei says, look, it's a risky proposition getting gold out of the ground and into production. It's probably pretty exy as well. Thanks, guys. Thanks, Jun Bei. Thank you, Adam Dawes, for joining us remotely today. We do appreciate your insights. And we hope that you guys have a good weekend. And we'd also just briefly like to thank all of our expert guests for putting their necks out there, for giving us their life-changing stock picks over the past couple of weeks. It's been a lot of fun. I know that our viewers really enjoyed the series as well. We will look to do something similar in the not too distant future. Always feel free to flick us an email, the call at ausbiz.com.au. And remember, you can check out that portfolio at ausbiz.co/portfolio. Don't forget to subscribe to the AusBiz newsletter. It's a cracker. It's called the COB. We love putting it together. It's got our views in there, a couple links to the interviews that we're highlighting for the day. We look forward to that one. And don't go anywhere. Don't forget, we've got The Pulse coming right up. More stock picks, more great interviews. Cara Ordway will be here with you shortly. We are just past 4 p.m. Scotty, a positive finish for the Chi-X 200. It looks as if the XJO will finish in positive territory as well.
You just reinforce that view that we're starting to go and see that real thematics play out again.
Can't be watching all the time, right?
Largest listed company in the world. Well, that is